Every investor shares the same fantasy: find a tiny, unknown company, buy the stock while it's ignored, and wait for the market to realize its value. The reality is much harsher. When amateur investors buy what they think is a cheap stock, they are often buying a dying business that will continue to lose money until it files for bankruptcy. Value investing requires a method for distinguishing between a temporary market overreaction and a business model that is structurally broken. Without a systematic way to separate potential winners from companies in terminal decline, an investor is relying on hope rather than data. To understand why professional investors hunt in this space, we have to look at how the market prices companies based on their total market capitalization. This chart looks at historical market returns by company size. Notice the left side. The very smallest companies generate significantly higher annual returns than the massive, established companies on the right. Finance researchers call this gap the small firm premium. This premium exists because of a concept called information friction. Large companies have dozens of institutional analysts tracking their every move, making it rare for their stock to be dramatically mispriced. Small companies are often ignored by Wall Street. That lack of oversight makes it more likely that their stock price does not reflect their actual value. Here is the trade-off. The less information the market has, the higher your potential upside. But that same lack of information severely increases the inherent risk of you losing your entire initial investment. Most retail investors try to capture this small cap premium using surface-level metrics. They open a screener and look for a low price-to-earnings or price-to-book ratio. It takes about 30 seconds to generate a list of companies trading well below their historical or sector averages. The flaw in this logic is that a low P/E ratio is not a guaranteed signal of undervaluation. Often, the market prices a company cheaply for a specific reason. These basic ratios usually reflect a failing business model, persistent quarterly losses, or an inescapable cycle of debt. Relying exclusively on basic stock screeners to find misvalued companies often leads investors directly into a value trap. Institutional value investors take a different approach. They use a structured elimination process designed to discard weak companies before they ever enter a portfolio. Look at this graphic from a professional management firm. Finding winners requires starting with a massive universe of over 1,000 potential stocks. The first filter relies on forensic accounting screens, eliminating companies with subpar accounting or earnings manipulation. The research cost here is quite significant. It requires analyzing 6 years of historical consolidated financials across a dozen different parameters just to ensure the numbers are real. The final stages involve intensive research, physical channel checks, and verifying management claims to isolate the final 15 or 20 targets. Successfully engineering the small cap premium requires eliminating 98% of your initial ideas. You have to act like an auditor, not a speculator. We can break down the specific indicators these auditors use to evaluate a company's financial health. On the red side, you are likely looking at a value trap if receivables are rising faster than actual sales, if the working capital cycle is constantly stretching out, or if you see an illogical increase in promoter pledging. Spotting these warning signs prevents investment in companies that rely on artificial growth or suffer from severe corporate governance issues. For the green flags, frameworks like the Piotrowski F-score demand hard evidence of financial strength. This means strictly filtering for companies generating positive cash flow from operations and demonstrating a growing return on assets. You may miss out on a stock that spikes purely on market hype, but adhering to these strict rules is mandatory for protecting your capital over the long term. The forensic funnel works, but it demands a high level of research capital, time, and expertise that many individual investors lack. You must align your chosen investment strategy with your actual resources. We can split investors into 3 profiles. If you are the indexer with limited time, avoid individual microcaps entirely. Utilize structured mid-cap funds where institutional oversight limits exposure to blatant fraud. If you are the screener and pick individual stocks, you must commit to calculating free cash flow and analyzing debt ratios. If you do not, you risk significant losses. And as this portfolio manager's slide details, if you are the allocator seeking higher premiums, you have to outsource to professional teams who can perform extensive physical due diligence, like factory visits and dealer checks. Mismatched strategies lead to wealth erosion. you cannot extract a premium return using a low-effort strategy. While the market provides opportunities for higher returns in smaller firms, capturing that premium requires a commitment to exhaustive due diligence. Upside potential is linked to the difficulty of deep research and the risks associated with holding illiquid assets. A stock is not a sound investment simply because its price has declined. True value is only captured when your forensic research proves that the rest of the market's current price is objectively wrong.